Welcome back, everybody. The market dropped quite a bit yesterday, and so naturally, everyone's trying to explain what's going on. Now, for the most part, people are blaming a hotter than expected inflation report, signaling that the fight with inflation may not be over and the Fed may delay cutting interest rates. And now I know I've talked about these type of things before, and that's why I like to revisit them anytime that they happen so that we can try to make some sense out of how the market moves and see if there's anything important that we can actually take away from it. So let's start with Liz Young and her take on what actually happened yesterday.
How much of a blow have the bulls suffered today?
I mean, it's a tough day, and we have to pay attention to that, right? One of the things that we always talk about is you can't fight the tape. The tape is always telling the truth about what sentiment is, but we're coming off such a strong rally and such strong sentiment that it's still yet to be seen whether or not dip buyers will come in here. I mean, 700 points on the Dow is certainly a big drawdown. I think the message that it's sending is that if you were investing and buying stocks based on rate cuts coming soon and coming in a big way, you have to rethink that thesis as we continue to push rate cuts out further and further. Now, that doesn't necessarily mean that the market has to have a 20% drawdown, right? I mean, the longer we wait between hikes and the first cut, the market actually tends to do okay. But certainly today, we need to reprice some of the expectation that the Fed was going to come in and support valuations at this level very soon.
And I think she made a couple interesting points here. She mentions that we've been in a good rally, so the question will be whether or not investors see this dip as one that they're going to buy, or if they're going to wait to see if it comes down a little bit more. And we'll talk about that more in a minute. But also this idea that if investors are waiting for the Fed to start cutting rates to allocate more of their money into the market, and this is an idea that I touched on a bit in my video about why stocks are going up. And I showed that it seemed to me more likely that GDP growth was a better indicator of what was driving the rally as opposed to any anticipation of rate cuts. But my general thought on this is that if there are still investors who are on the sidelines waiting for the Fed to start cutting rates, then, the S&P 500 was up over 26% last year. Most of big tech and semiconductor stocks are crushing it in the first month and a half of 2024. So I'm not sure of the significance of actually waiting for a rate cut unless they're looking for a specific type of stocks and sectors that have underperformed, and that's where they want to put their money in. And they actually asked Liz Young how important she thinks rate cuts are later on in the interview.
But there are some who make the argument that a strong economy at this point in the cycle is more important than rate cuts anyway. That's what you should hang your hat on. I mean, that's what Professor Jeremy Siegel of the Wharton School told me just the other day. I want you to listen to what he said as he remains bullish and not reliant on rate cuts.
At this particular point, I don't see the need for the Fed to lower. I mean, take a look at all the real indicators. They haven't slowed down. Even the advanced indicators have not slowed down. When they begin to slow down, that and if inflation's under control, which I do think it is, we're going to have those lowering of rates. But I'm not saying that this bull market at all depends on the rates being lowered in March or really even in May.
You agree or disagree with the professor?
So I agree that a strong economy is obviously a bullish thing for stocks. The issue here is that a strong economy also keeps inflation higher, and it prevents inflation and disinflation from broadening out into all the areas that we need to see disinflation. So what it's doing is it's lengthening and elongating this waiting period of when we're going to see the Fed actually be able to come off of their hiking path. And I think that the Fed is going to have a lot more ability to wait than the market is. And a lot of this market move has been predicated on the idea that CPI has come down. I think a lot of people expected it to keep moving in a linear fashion, and that was proven incorrect today, or at least that now it's sort of plateaued at a level that's still uncomfortable. So I think the market is going to have to get to a place where it makes more sense to be trading at certain valuations in the face of a strong economy, yes, but also in the face of inflation that stays higher than we want it to be.
And this idea about inflation staying higher and delaying ultimately what needs to come is something being talked about by others as well. Let's listen to Brent Shute as he breaks down his similar point of view.
And so to me, what's going to happen is the Fed's going to leave rates elevated. The longer they leave rates elevated, the more it works its way into the economy. And that will eventually cause the consumer and corporations to have some weakness, which will lead to that short, shallow recession that we believe is on the horizon.
Lael Brainerd from the National Economic Council just told us don't pay too much attention to one number. And the broader trend is that we're seeing good growth and inflation come down without disrupting the labor market.
I'm not for sure. I mean, if you look at different measures of CPI, so for example, I mentioned the Cleveland Fed median CPI, which they believe provides a better view of the underlying trend of inflation. It bottomed in July at around 2% on a 1 month annualized basis. It's pretty much gone up every month to now being over 6%. That is not an underlying trend of inflation that's crumbling. Core services, which is tied to wages, has actually been rising for some time. It's in the 6% on a 3 and 6 month annualized basis. And so, yes, goods inflation has come down, but other measures of inflation that are more tied to the business cycle are not. And that's where the big issue is to me. I mean, wages running at 4.5% to 4.8% is not consistent with sustainable 2% inflation. It's more consistent with the end of a business cycle, which is where, unfortunately, I think we're at.
And one thing about him is that he definitely has been consistent in what he's been saying. But when you look at the market, at least right now, it doesn't really correlate to what people are talking about in their everyday lives. The market is up to new all-time highs or close to all-time highs, and yet people are feeling the effects of higher prices, at least to where it's getting talked about. Now let's listen to Brent break down more of what they're seeing in the actual data.
I mean, the consumer has largely been insulated, at least the higher end consumer, from the rise in interest rates because 66% of debt, consumer debt is mortgage debt, and it's fixed. You're seeing it start to crack at the lower levels. You're seeing delinquencies increase. Corporate debt, corporations termed out their debt. That's now repricing. Commercial real estate is repricing. And so the longer that rates stay elevated, which I think is likely to be the case because inflation is not over yet, the more it works its way into the system, which I think causes layoffs to occur. And you have seen signs of weakness in the labor market. Just think about corporate revenues this quarter growing at about 3.8% while wages are growing at 4.5%. That math doesn't work forever. And so I think you're going to see layoffs, which to me is kind of the final peg before we get a recession. I think that's unfortunately the horizon.
And there definitely is some truth to what he's saying. Because if you just look at the layoffs that have been in the news lately, they're all over the place. Instacart and Paramount Global announced just this week. Hershey's announced last week. Google, Amazon, TikTok, Sports Illustrated, and this just off the top of my head. I mean, the list goes on and on. But the question is, at what point is this going to be felt within the household to where people will just have to cut back on spending? We talked about it already with American Express, but you can see charge-off rates increasing for credit card issuers, which means that eventually they're going to take higher losses if that continues to rise. Now, how much impact will that have? What scale will the impact be? We don't really know at this point, but it could still be likely that we see more issues in our economy, even if stocks are doing well. The question, though, is how much do the inflation numbers actually impact the market or what we even saw yesterday? And Mona Mahashan talked about that a little bit here.
And I guess we'll just start out, Mona, if you think that this sell-off is an appropriate reaction to the data. I think Rick and others bring up a very interesting point about January being a reset month for prices.
Yeah, absolutely. And look, I think others have brought up this point as well, but we moved almost 22% higher in a straight line in the S&P 500 since October 27th of 2023. So were we due for a bit of a pullback, a correction, at least a period of consolidation? The answer there is probably yes. And was this CPI report a catalyst to get us there? Perhaps. And look, there was some disappointing data in the CPI. We saw shelter and rent components higher than we'd like to see. We saw headline inflation, which we thought we'd get a two handle on, finally come in at 3.1%. But when we look broadly, the trend in inflation is still moving in the right direction. We were at 3.4% on headline last month. We're at 3.1% this month. Core inflation remains flat at 3.9%, but we think there are signals that could get us to a more moderating trend even there.
And I really think Mona hit the nail on the head here because we get so caught up sometimes in why did the market act this way? So we create these narratives as a way to try to understand. But sometimes it's just normal market fluctuations and traders using technical signals. And I talked about this with Visa in my newsletter a few weeks back. It had dropped 3% after earnings for really no reason at all, but it had been going up in almost a straight line for the 3 months prior. So it was likely just traders taking profits and not really a big deal at all. So that's why I personally bought the dip. And if you look at the S&P 500 right now, it's basically the same thing. 14 out of the last 15 weeks have been up, and that's not really normal. So we should expect a little bit of a correction just because that's what markets do. Nothing ever goes up in a straight line. And the market's constantly taking this new information and resetting expectations for the future. And Mona talked about that a bit later on.
Or does this push out potentially their decision to cut interest rates a meeting or so beyond maybe where they would have before this data came out?
Yeah, look, the Fed has already told us that they want to be patient here, and they've earned that right. The economy was going in the right direction and inflation was moving lower even as we got this better economic growth. So they can certainly be patient here, wait, we think, until probably the June meeting. And we think now the market is pricing in somewhat of a more reasonable and better aligned number of rate cuts with what the Fed is expecting as well. So the market, as of this morning, looking at 4 rate cuts beginning in June. We're in the same camp, 3 to 4 rate cuts probably beginning in that June timeframe. Keep in mind, if the Fed were to do more than that, 5, 6 plus, it's probably because the economy has faltered in some way. And if they're going less than that, 0, 1, or 2, it's probably because inflation is continuing to remain sticky and the economy is also above expectations in a more meaningful way. And so we think there's a sweet spot that's emerging, that's 3 to 4 rate cuts, that gets the Fed gradually back towards a more normalized level of interest rates. And so we think what happened this morning is actually probably a healthy adjustment.
And again, if you just look at this on the chart, you could argue that it wasn't even really that healthy of a correction up to this point. There's still a lot of space there as to how far the market has moved up just over the past 3 months or so. So as investors, the question that we ask ourselves is this the beginning of a longer downtrend, or is it just a temporary dip that I should be buying right now? And Mona finishes up the interview with a similar idea.
There's really no impediment, is there, for it to continue to move higher? In other words, it's not as though the Fed or anybody is saying, hey, rate cuts are done. It's just a question of that anticipation before they start.
Yeah, I think that's well said, Tyler. And look, I think when we think about what could create or drive a bear market, usually it's if you're in a recession or entering a recession. It's also if the Fed is raising rates. And thirdly, you have your unknown geopolitical risks or an external shock that could cause disruption to the system. Neither of those three are in place today. So which makes us I kind of feel like if we are headed towards a period of volatility, a correction, that's really the opportunity, especially for those market participants that really didn't get involved late last year when we got that very rapid rise in the S&P 500. So we would take advantage of periods of volatility, position yourself for that potential for that Fed rate cutting cycle that we see emerging in the back half of this year.
So from her perspective, the catalysts that would turn this into a prolonged downtrend or even a bear market just aren't there. We're not in a recession or entering a recession at this point. The Fed is not likely to continue raising rates at this point either. And while there's always geopolitical risks or general shocks to the market that we can't predict, right now we don't have that. So she's looking at these dips as buying opportunities as opposed to something that'll be a longer term bear market. And her comment about positioning yourself to take advantage of those opportunities I thought was really good. And that's something that I'm trying to do for myself as well, as I'm holding more cash right now than I usually do. And that's mainly because I sold out of positions that I didn't think had the future growth potential that I want. And I'm waiting for a pullback on some really high quality companies that I haven't been able to add to my portfolio yet, or just ones that I already have but want to add more to. But even though everyone keeps saying that the market is so overvalued and all the Magnificent Seven stocks especially are way overvalued, I really just have a slightly different view on that. Because when you look at those companies, yes, their valuation isn't as attractive as it was in 2022. But for the most part, these companies are way more profitable than they were in 2022 as well. They're generating insane amounts of cash, and many of them are actually trading at better multiples than they were back in 2021 when the market was at crazy highs. So while I do think there's some pullback likely just because that's what markets do, I think if you ignore those top companies because you're concerned that they're too overvalued, you might be surprised at how well they continue to do. Because the growth rate of their profits in some cases is outpacing the stock price. And I touched on that a little bit in talking about why I added to Amazon even after it shot up after earnings. And yes, it's at all-time high prices, but the cash flow and overall growth prospects still look really attractive. And that's a common theme with most of the Magnificent Seven stocks right now. So I know a lot of folks are looking for these undervalued, great price metric stocks that are out there right now, but just remember, some stocks are cheap for a reason. And make sure you're considering the future growth prospects of the stock and not just how cheap it is right now. So what do you guys think about the inflation data? Is this something that you think is going to get worse, or is the worst behind us? Let me know down in the comments below. Now, if you want to see why I think GDP growth has been the main catalyst for the market's rise over the past 3 months, click on this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you guys in the next one. Peace.